Hey, everybody. Welcome. I wanted to walk you through the steps today. I've had a few questions about how to do a horizontal analysis on an income statement. So I thought I'd walk you through those steps and try to explain a little bit more about what a horizontal analysis is. So on the screen, you will see that I've got two income statements for the same company. One is dated December 31st, 2021. So for the year of 2021. And then the second is for the year of 2022. And we're going to do a horizontal analysis, which is just a way of comparing the two income statements over time. So the first thing we need to do to make this easy, okay, is we're just going to set up our income statements so that they are side by side here. And this will make our life a lot easier. So in essence, we're going to say this is for 2022. I just copied and pasted it. And then we'll take the data here from 2021 and put it right next to it. So this already starts to yield some results for us as we look at it to say like, oh, I can compare how they did. I can see that revenues were up in 2022 and some of the expenses had pretty significant changes. Others only had little changes. So that helps us kind of see right now that there's a difference. Overall, I can see expenses from 2021 went up to 2022 went up, and net income did too. So all that we're doing when we do a horizontal analysis is comparing the newer year to the older year. And so the first thing we'll do is we'll just calculate the change. And that change is just going to be the newer year minus the older year. So we can see now that our revenue went up $21,500 between 2021 and 2022. And we'll use that, we'll apply that same formula all the way down. I'll go ahead and delete this one because it's just on the expenses line there. All right, so we can see that our revenue went up 21,005. Our supplies expense went way down 7,920. Salary expense went up. No change to interest expense or studio rent expense. Utilities expense went up. Depreciation expense stayed the same. And our income taxes went up quite a bit. And then our total expenses went up quite a bit. And then our net income went up quite a bit. And so then we'll do one more column. We'll just call it percent change. And then all we're going to do to find the percent change is we're just going to take the amount of the change divided by the older year. So there we can see, okay, so revenue was a 25% increase. And again, I'll just fill that all the way down, delete this one that's on the line here, and then might make it nicer to express it as a percentage. And we'll give it 1 decimal. All right. So now we start to learn a lot, right? We can see that our supplies expense decreased by 88%. Our salaries expense increased by 30%, and so forth. We can see all those things. We can see our income tax expense really jumped up, but often as business owners, we don't have much control over income taxes. They're usually just a percentage of our profits before tax. And since our profit before tax nearly doubled, or almost doubled, then we would expect our income taxes to do the same. So what this does, what we use it for in real life, is it really gives us a starting place for questions. So if I'm the business owner, or if I'm an advisor to the business owner, I can sort of look at these big changes, and then I can't necessarily tell what happened. I can't say, oh, well, they started selling to more people, or they started selling their product at a higher price. But I can now say, man, 25% is a pretty good increase over last year. And I can sit down with that business owner and say, to what would you attribute this change? How did your sales go up 25%? How did you cut supplies expense 88%? And is that sustainable, or was that just something special for this year? Why did our salary expense go up 30% when our revenue only went up 25%? And do we expect that to continue? Or was there some special cause? And so what we try to do is sort of ferret out what caused the good things and find ways to continue that positive trend, and ferret out what caused the bad things, like our salary expense going up faster than our revenue, and find ways to mitigate that. I mean, we might just say, hey, that's what it costs to make that higher level of revenue. And overall, we're still making quite a bit more net income, so it's worth it. Um, or we might say, hey, I have a solution for dealing with that. Anyway, so that's a horizontal analysis. It's called horizontal because we're looking at the changes in time across the statement. And so just like the horizon goes across, they use the term horizontal to discuss looking at the same statement spread out over time and looking at the change between various time periods in that way. So I hope that was helpful to you. As always, if you have questions, put them down in the bottom there. Just go ahead and post them, and I will do my very best. If you have some problem you're working on and don't know how to figure it out, post that down there too, and I will respond. Like and subscribe if you can. That helps get this content out to more people who it might help. Anyway, have a great day, and thanks for watching.